green shoots in the domestic manufacturing sector are bullish for risk assets as well. So in this chart, we're showing the number of industries reporting overall growth. So it's the diffusion index effectively, the PMI. Sorry, not a diffusion index. It's just the total number of industries that are reporting growth within the manufacturing PMI. And we bottomed a couple of months ago. We're back up at 8. And the reason that bottom is important is because historically speaking, we have seen significant returns in the equity market a year after those bottoms. Specifically, if you look at the so we bottomed, I want to say in 2001 in this time series. We bottomed in 2008 in the time series. We bottomed in, I want to say, 2012. We had a bottom in like 2015, 2016, and then we had a bottom, I want to say, in 2020. And if you look at the median return 1 year forward from each of those bottoms is plus 28% for the S&P 500. And it's the percent positive ratio is plus 80%. So again, think about this thing bottom, I want to say, in December. Think about a 28% return in the stock market in 2024 as a baseline expectation with a pretty much 80% positive ratio. So you want to haircut that by 0.8, let's call it, I don't know, 22%. That's pretty significant. That's pretty significant. So I just want everyone, 21%. So, or yeah, 22, 20. Yeah. So that's, I just want people to be aware, I want investors to be aware that there are some positive fundamental economic dynamics that are contributing to upside risk in asset markets right now. They won't be persistent forever. They won't last forever. Eventually, we're going to have problems with inflation again. But now is not the time to be concerned about that. Now is not the time to be concerned about all the regional bank bear porn, all the commercial real estate bear porn, and all the other various forms of bear porn that people are out there getting off to with their newsletters and their ads that they're selling you. That's neither here nor there. That's not what we're trying to do here. We're trying to help you make and save money by staying on the right side of market risk. And the right side of market risk is to be bullishly positioned, as our models have been calling for since the beginning of November, when our positioning model got involved. But even if you didn't buy it then, you could have gotten in by mid-November in terms of when the global macro risk matrix told you to get involved in the Goldilocks. And we've generally been in Goldilocks since. We had a cup of coffee and reflation, but now we're back to Goldilocks. So it is what it is. They're both risk-on regimes.